Carvana just reported a net income growth of 570%, yet Wall Street responded by slashing price targets as the company simultaneously diluted shareholders with a $1.23 billion equity raise. Good evening and welcome to the CFO Suite Market Intelligence Desk. While the headline noise centers on a fourth-quarter earnings miss that prompted UBS analyst Michael Lasser to trim his price target to $485, the underlying unit economics tell a far more aggressive story of institutional-grade recovery. To understand the trajectory here, you have to look past the top-line miss and focus on the trailing 12-month EPS of $10.22. This represents a year-over-year earnings per share surge of nearly 495%. Carvana isn't just selling more cars, it is fundamentally re-engineering the spread between acquisition costs at auction and retail execution. The critical friction point in the recent filing isn't the demand side, it's the capital structure. Carvana's decision to execute a $1.23 billion equity offering serves as a strategic fortress-building move, intended to delever the balance sheet and reduce the interest expense that has historically eaten their gross profit per unit, or GPU. Critics point to the dilution, but the smart money is looking at the 6.92% profit margin, a figure that was unthinkable for this business model just 24 months ago. They are now outperforming traditional peers like CarMax and AutoNation in terms of digital conversion efficiency, leveraging their proprietary ADESA physical auction locations to shorten the logistics chain between reconditioning centers and the end consumer. The real alpha is found in the operational leverage. During the Q4 earnings call, management highlighted that while higher inventory costs and logistics bottlenecks created a temporary drag, the long-term runway for growth remains intact due to their vertical integration. By controlling the inspection, reconditioning, and financing through Carvana Auto Receivables Trust, they are capturing the entire value chain. If this level of institutional analysis is giving you an edge, hit that like button and subscribe. We do this every single day. Our earnings trend analysis model suggests that the 570% net income growth isn't a one-time accounting fluke related to debt restructuring, but a sustainable shift in operational velocity. Despite the Q4 miss, the company is seeing a stabilization in the used vehicle price index, which allows for more predictable margin forecasting. UBS maintained their buy rating for a reason. The infrastructure Carvana built is now a high-moat asset that competitors cannot easily replicate without massive capital expenditure. The move to $485 as a price target still implies significant upside from current trading levels, reflecting a belief that Carvana's proprietary software stack for appraisal and trade-ins is successfully pricing risk better than the broader market. The catalyst to watch over the next 2 quarters is the integration of AI-driven logistics to further reduce the days-to-sale metric. As they optimize the $1.23 billion in new capital, expect a pivot from defensive balance sheet management back to offensive market share acquisition in the Sun Belt and Midwest regions. We are maintaining a bullish outlook with a confidence score of 80%, predicated on the fact that Carvana has successfully transitioned from a growth-at-all-costs disruptor to a structurally profitable retail powerhouse. For more deep-dive breakdowns and to stay ahead of the next major market move, make sure to subscribe to the channel. This analysis is powered by the CFO Suite.ai. For more institutional-grade financial intelligence, visit thecfosuite.ai. This content is for informational purposes only and should not be considered financial advice. Always consult a qualified financial advisor before making investment decisions.